Hi, this is Dean Hoffman, and I want to thank you for tuning into this video presentation. As you can see, the topic is going to be the single biggest investor blunder and also how to potentially profit from it. This is a blunder that I have seen made many times in my many years in the brokerage business. I saw hundreds, if not thousands, of accounts, and this was a very typical blunder. And without any further ado, let's just get right into the material. One quick stop here. I do want to remind those of you that new or experienced in commodities for that matter that there are risks associated with commodities. They're not suitable for all investors, and you'd certainly want to familiarize yourself with any of those risks before making a decision to invest. Let me start out this explaining this blunder by introducing a paradox that will kind of help to crystallize the phenomenon that's taking place here. Many consistently profitable money managers have lots of losing clients, and this sounds paradoxical at first. And what I'm talking about when I say profitable money managers are commodity trading advisors, individuals who, in some cases may have billions of dollars under management, who have been tracked for 10 or 20, in some cases as long as 30 years, who have been very consistently profitable year in and year out. They might have had a losing year here or there, but for the most part have done well. And the question becomes, if they have done that, then how is it that there are so many losing clients that come from those money managers? Okay? And incidentally, this study was done by Jack Schwager in his book, Managed Futures Trading, Myths and Truths. And if you haven't read it, I highly recommend it. For those of you who know who Jack Schwager is, probably nothing more needs to be said. For those of you that don't, he's pretty much an icon in the futures industry. He's written what are probably considered to be the finest futures trading books ever written, for that matter. The answer to this problem, or paradox, or question, is actually extremely simple. If you can look at this graph right here, let's assume that this is a 20-year or a 5 or 10-year, it doesn't matter the time frame, graph of a consistently profitable manager. You can see that, okay, let's assume he started here, and now today he's here. And we can see clearly he's considerably higher than where he started. Okay, that could be $100 or $100 million, whatever the case may be. What tends to happen, though, is that the typical investors that, or I shouldn't say, well, sometimes typical, a lot of investors, let's put it that way, tend to buy into these managers at these peaks. Okay, they make their decision to invest based on who is currently hot, what's the flavor of the month. And they'll tend to buy into these managers around this level right here, and then sell out once there's a drawdown and say, I knew it, this guy's no good after all, and they'll get out there. And then the cycle repeats itself again. And then you'll see a lot of new money enter into these managers right around this area. And once again, right around here, you'll see a big exodus. And you can look at a lot of the graphs that compare performance to funds that are injected into these managers. And it's amazing. The most money that comes into these managers is typically when they're sitting at some kind of an equity peak. So what you're really suffering from here with these investors is bad timing, illogical, emotional decisions, always buying what's hot, okay, what's currently done the best, which is a terrible strategy. I mean, when you think about it, if making money was as easy as buying who's currently doing the best, we'd all be billionaires. And since that's clearly not the case, I think it's safe to assume that that is not a sufficient strategy. Bailing out at the wrong time, all of this ties into a lack of discipline and emotional control. And right out of Jack Schwager's book, a direct quote, I'll read it. The common dual tendency of many people to initiate an account after a manager has already had a winning streak and to liquidate an account in the midst of a drawdown probably represents the single worst investor blunder. I couldn't agree with it more, and that's in fact why I named this presentation the single worst investor blunder. What is the solution to this problem? Well, I'm going to get into some specific tools in a little bit. This is kind of generic stuff here right now, and I'm going to get into specifics. But the kind of the bird's eye view of the solution is to separate the process of selecting investments from timing them. When you're making an investment decision, select that investment, but keep that decision-making process separate from the timing of when you want to be in it. Out of Jack Schwager's book and the study he did, again, I'll read, the performance differentials were so pronounced and consistent for the data study that barring future evidence to the contrary, it seems safe to assume that initiating CTA investments on drawdowns is far preferable to launching accounts right after highly profitable performance periods. And again, this is what most people do, and unfortunately this is what a lot of brokers sell. Who's ever the hottest, who's currently had the last 12 months, has done the best, or has done the best this quarter, tends to be what gets sold because it creates emotion in people and causes them to do things with bad timing. Now, this does not mean that you should buy a bad manager. Okay, it's possible that the reason he is doing poorly is because he's just a bad manager overall, and this point is at home here with this next quote. The message here should not be confused with implying that one should invest with losing CTAs as opposed to winning CTAs. Rather, the intended message is that one should first select a CTA by whatever method, and then invest with that CTA after a losing period as opposed to a winning period. If readers only absorb one fact, it should be this: separate the process of selecting and timing investments. And once having selected the investment, wait for it to do poorly, not well, before actually initiating the investment. Okay? This is a very, very difficult concept for people that are not sophisticated in the markets because, quite frankly, it takes a lot of insight and discipline and emotional control to invest in something that isn't currently doing well. It just seems counterintuitive to invest into something that's recently not done well. But quite frankly, the statistics and the data, at least in this universe, I think can very clearly prove out that that's precisely when you want to do it. Now, there's a new problem that this theory brings upon us. Okay, in some ways it's rather generic and superficial, just simply to say invest in a manager when he's, going to invest in a good manager when he's going through a poor period. The kind of questions that come up are these: at what point during the drawdown do we enter? All right, let's say he's down 5%. Is that the entry point? Well, maybe. If you predict the worst drawdown he could have is 6%, then probably entering at 5 is the right place to do it. However, if that manager could have a 50% drawdown, you might not want to invest in 5 because maybe you'll lose another 45% first. So there needs to be a way to define at what point during the drawdown period do we enter. And I'm going to get into some tools here coming up that I believe answer that question. Again, this kind of ties into the previous point we made. What if the manager just keeps losing more money? How will I know where to stop trading? Okay, if I buy into a drawdown and it keeps getting worse, is there some uncle point? Is there some logical place that I'd want to pull the plug? And what statistical tools can we use to quantify this and to make good decisions about when to jump on board? This is what I'm going to get into, are the specific tools that can be used to quantify this and measure this and help us make good decisions. Let's look at ways that drawdowns are typically predicted. Okay, most of them are flawed. The one that I've seen most often is to look at a worse drawdown in the past and then somehow assume that that is the baseline of what could be a worse drawdown in the future. So if you're looking at a manager and one time in the past he had a 20% drawdown, then I've seen people say, well, that's the maximum, predicted drawdown is 20%. I've seen this with trading systems to look at what has been the single worst drawdown in the past. The problem with that kind of thinking is that future drawdowns frequently look much different than past drawdowns. And it's been said, and rightly so, and you've probably heard, that the largest drawdown is likely going to be in the future. And one thing I've learned very, very well over the last 10 years in researching systems and also trading, I trade for myself, is that looking at old historical drawdowns, I don't want to say it's meaningless, but it can be misleading and deceptive. The future drawdowns can certainly and easily be beyond what the old ones were in size. They might be less. It might take 50 years till there's one bigger, or it might be in the next 6 months. But if your only strategy is to just simply look at what drawdowns were before, I think that it's a very flawed strategy. So the question becomes, how can we predict how big a future drawdown might be? I mean, if you think about it, if there was really a way to predict a future drawdown precisely, there's not, but if there was, we could all be gazillionaires, because if we knew that this program could not exceed a 10% drawdown, and we absolutely predicted that and knew that with certainty, and for some strange reason that program went into a 10% drawdown, and we knew it could never exceed past that, you'd be crazy not to mortgage your house and your cars and everything you possibly had to buy into that investment at that point, because essentially what we're saying at that point is the risk is zero. It can't exceed a 10% drawdown, and it's currently at a 10% drawdown, so there's only one direction it can go from here, is up. Well, clearly we can't do that, but what I try to look at is, are there ways that we can sort of try to do that? Can we come close to what could be a logical predicted maximum drawdown? And I believe that the best tools on the market to do that are Monte Carlo simulations. Okay, whoops, went too far. Monte Carlo simulations, probably most of you have heard of them. If you haven't, they were developed during the Manhattan atomic bomb project in the 40s. They become very popular. Simulations involve feeding a large number of random inputs into a model, recording the outputs. It's a great application for high-powered computers. For those of you that aren't familiar with Monte Carlo simulations, I'll give you just a very quick overview understanding of what Monte Carlo does. Basically, a Monte Carlo looks at the sequence of events. And let's look at an example of flipping a coin. And let's say that every time we flip the coin, you and I play a game. Every time we flip a coin and it comes up heads, you win $2. Every time it comes up tails, you lose $1. Your starting capital is $5, and there's 50-50 odds that it could come up heads or tails. Here's where you can see where sequence plays a very important role. If you start out the game flipping 5 tails in a row, you're out of the game. You just lost your $5. However, if you had a different sequence, if you started out flipping 5 heads in a row, or 3 heads and 2 tails, etc., you'd have an entirely different outcome. So what you can see is that given the same exact payoffs, percentages, probabilities, the outcomes can be entirely different depending on the sequence by which things occur. And that is, and what a Monte Carlo simulation does, is it takes the output and it reshuffles it tens of thousands, hundreds of thousands, millions of times, however many times you choose, and gives you all of the possible outcomes it came up with, and then reduces them down into percentiles. It says, 50%, out of the million runs we did, 50% of them fell within this range, 60% fell within that range, 70%, etc., etc. And the one thing I want to mention with futures is that I think a lot of Monte Carlo simulations are done wrong. A lot of simulations are done based on trade outcomes, which is kind of silly, because you can have 4 losing trades in a row, yet still be making new equity highs if you simultaneously have on 4 winning trades that have been moving higher at the same time. So, and it's the other way around. You could have 4 winning trades in a row, but be making new lows in your equity if you have 7 losing trades while you're having those 4 winners. So what you need to look at is the daily percentage change in your account, and then use that daily percentage change as part of what constitutes your Monte Carlo simulation. So I'm going to get into a Monte Carlo sim with a very specific model and show you the stats. To summarize this, the benefit of the Monte Carlo simulations is they give us a statistical method to define risk. It's not exact, it's not precise, but in my opinion, it's the best that we have, and it's a very robust way to use probability-based math to determine what the maximum drawdown ranges and risks should be. The benefit of this is this can help us to determine an account size. Again, I'm repeating here, it gives us a statistical basis for predicting a future drawdown. This can help us pinpoint our entry. once again, if a Monte Carlo sim tells us that the maximum drawdown could be 20 and we're already at 15, that's probably a good entry. But if it tells us the maximum drawdown could be 80 and we're at 15, that's still too far away. So by having this information, it helps you know where in that drawdown may actually represent an opportunity. And to me, what this really means is the possibility of increasing the odds when the risk is the lowest. Again, I can't guarantee that. This is just my opinion. But if you can enter into the investment at a place where your statistics have told you represent the outside band of where the risk could be, and if you're close to that, that tells me that you could get in at the place where the risk is the lowest. And also, I believe this can also get us in at the point where the potential for the profit is the highest. Because my experience in testing systems has been that after a system has had a period of drawdown, that typically speaking, the next 12 months, or I should say it's not unusual for the next 12 months return to be above what would ordinarily be the average return of that system. Maybe it's somewhat like a rubber band effect. If you pull it down far enough, when you finally let go, it kind of springs back up. So at this point, I'm going to move away from the PowerPoint presentation, and I'm actually going to move over to another platform to show you a specific demonstration of what I think represents an excellent current opportunity. Okay, what we are looking at here is a report generated from the Mechanica backtesting software. And for those of you, I'm not going to go into detail about Mechanica, maybe in a separate presentation I will, but just briefly, Mechanica is, in my opinion, by far the single most powerful backtesting software in the world. I believe I've seen most of what else is available out there, and it's expensive. It's about $25,000 per copy, but in my opinion, very well worth it. And its predecessor was a program called Trading Recipes, which was around for probably since the early 90s, and I was using it until then. And then when Mechanica came out here a couple of years ago, it really just created a new paradigm in terms of what was available, both in developing systems and money management and testing and etc. So anyways, I'm going to briefly summarize a few points here and really then get to the main point, which is how to use the Monte Carlo simulation to predict drawdowns and also to then use that information to help time entries. Let me just quickly summarize this output. This is the one tab out of many tabs, and there's many more hidden behind these menus, that shows the performance of a series of systems that I actually trade myself. This is, as I said, a number of systems with multiple different levels of money management rules incorporated into it. It's a very robust test in the sense that it was tested across 74 different markets, global markets. It was tested since 1980. It generated 14,232 trades that were rejected and 1,794 trades that were accepted. So roughly about 16,000 trades were comprised this test. So for you statisticians out there, I think you would agree that this represents a pretty robust model. In terms of performance, this is in line with my personality of what I'd like to see. The system's been designed to earn about 30% a year. Here you can see the actual numbers, 31.6. The maximum drawdown thus far, and I want to emphasize thus far, has been 9.4%, and we're going to get into this in a little bit because my prediction is this number will someday be bigger, and the key question is how much bigger could it be, and how can we compute that and then use that information. Some of the main ratios that are used in the industry, MAR ratio, which is very simply the return divided by the drawdown. Here it's 3.36. Oftentimes in the professionally managed world it'll be 1 or less. The Sharpe ratio, 2.37, return retracement ratio, 22.44. From a back-tested perspective, these are, at least in my opinion, very impressive numbers, and probably has a great deal to do with why I actually commit my own funds to it and trade it. But to get to the important question here, let me point out an interesting facet of this performance right now. Let's look at a logarithmic equity curve. Let me remove some of this clutter. And here the green line is the growth of equity. The red line represents drawdown. And one of the things that may jump out to you, or it may not, is that the drawdown right here in the red recently was at the greatest level that it's had in its testing period. And to some of more novice investors, that represents some kind of red flag to them. The reality is that it's fairly irrelevant information. When you really think about it, here's an example right here. If you look at this red line, at the time this drawdown occurred, at that point it was the single largest drawdown it had had up until that point. And you can see that from there forward it did extremely well, probably had some of its best years. And at this point it was its worst drawdown, and of course it did very well for a long time. So that statistic in and of itself isn't very meaningful. The future drawdown is almost always, or the drawdown, your largest drawdown is almost always going to be in the future. So the point is not to avoid it, because that's impossible. It's like trying to avoid death or taxes. The point is to try to understand what it may be, so that you can then use that as beneficial information to time an entry and possibly get in at the best possible time. Would you rather buy something that is at a very high level where the risk is the highest, or would you rather buy it when it's at a low level where the risk theoretically could be the lowest? Well, I think we know the answer to that question. So, without any further ado, let me just jump right into the Monte Carlo simulation. And incidentally, there are a number of different ways to try and project future drawdowns. Some involve multiples of monthly standard deviation, etc. I happen to find the Monte Carlo simulation to be the best. So we're going to go ahead and run this. We're going to run 10,000 simulations. We're going to use 1,000 different data points in each one of these 10,000 simulations. We'll go ahead and process this. I'll go very quick on my new Core 2 Duo processor. It's the fastest thing I could get. And what this leaves us with is a lot of different tabs of information, and we can get it both in a graphical format and also in a tabular format. But let's just briefly look at what this has told us. This is set out of 10,000 iterations, okay? In other words, taking this data that created this equity curve, we randomly took 1,000 different points of daily change out of there, and then we did that 10,000 different times to get all sorts of variable outcomes. You remember with Monte Carlo, sequence is a critical component. And when we did that, this yellow line here represents the average drawdown. The average drawdown out of those 10,000 iterations was a little bit over 10%. And you might find that interesting because the actual drawdown, that maximum drawdown that it's had thus far, it was in the 9% range. But the average is actually about 10. But what I look to more importantly, what some novices may do is they may look at the equity chart and say, well, okay, let's say that they'd only traded up until this point. They may say, well, the maximum drawdown in the past was, 8-something%. Here was 8, around 8. So the maximum, in the future should be about 8. Well, that's extremely flawed because that isn't using the math that you need to use to project what the future drawdown may be. So rather than do that, what I like to do is look at the Monte Carlo and say, okay, out of 10,000 different runs, if we use the 95% confidence level, and in statistics that's generally considered the number to use, because if you go beyond 95%, then you have to start asking yourself whether there's something wrong with the system altogether, and whether you shouldn't just simply stop trading it because now something's happening that shouldn't be happening. And there's a benefit to that because that could be your line in the sand, your uncle point, if you will. So what I do is I say, okay, out of all of the 10,000 runs, 95% of the drawdowns fell within which range? And here you can eyeball this, and it looks like it's about 18%. Okay? One thing I can do is I can actually export this to actual tabular format and see precisely. And here's the 95% range. You can see that 95% of all the drawdowns fell within 15.59%. Okay? And we're currently at about 9. So if you're thinking the way I'm thinking, you might be saying, well, if we're at 9 and we have a statistical basis to believe it shouldn't exceed about 15, that tells me we could get in right now and risk 6%, and that could be our uncle point. All right? Now think about this. If you weren't currently in a 9% drawdown, this 15 would still be the same. So to get in without it being in a drawdown, now you're back to risking the 15.59 instead of going in risking the 6%. Okay? And even if you expand this out to the extreme, okay, look at the 99 percentile ranges. You're looking at drawdowns of about 21-22%. What this tells me, in my experience with investors, many years as a broker, I also manage money, I also trade for myself, I find that 10 to 20% is the realistic number that most people can deal with in drawdown. I've had those tell me that they could deal with 30 or 40, but let me tell you something. The guys that tell me, or the women that tell me they can deal with a 40% drawdown, when it gets to 20 or 25, they are completely freaking out. Okay? So experience has told me that this is an area, this investment, or maybe any investment, you really need to try to probably keep it within 25% at the maximum for the real aggressive, and maybe closer to 10% for the real conservative. And my point very simply would be is that right now, if you look at the Monte Carlo simulation and say that the 95% confidence level tells us that we haven't seen a drawdown beyond 15%, and even if you go up higher than that into the 99% range, it's at about 20-21%. And if we look at the fact that we're currently at 9.5%, then that tells me the risk that we have from 9.5 to 20.5, okay, is about 11%. Or from 9.5 to 15.5, about 6%. So if you're somebody that's looking to risk 6 to 11% of your investment, I would make the case that this is the time to do it. Because if you waited until this investment recovered, let's assume this does in fact recover and shoot back up out of the drawdown, and now you're currently sitting at a 0% drawdown, that doesn't negate the fact that you could still at one point have the 15 or 20% drawdown. So by waiting till there's no drawdown and by buying on new equity peaks, what you're essentially doing is buying when the risk is the highest. And the other thing that I've tend to find over time is that after these drawdown spikes, it is not at all unusual for the next 12 months to be outliers to the upside in terms of return. In other words, if the average yearly return was, let's say, 30%, in my research I found that it's not unusual after a drawdown spike that the next 12 months might be 40 or 50 or 60 or 70%. So when you look at it that way, it could almost be viewed as a double benefit, that not only are you potentially getting in when the risk is the lowest, but this is happening at a time when the possibility of a spring back and the return could be an upside outlier. Possibly the odds of that currently are at the highest. So basically what I'm presenting in this scenario, I have some systems, and particularly if you combine them with the right combination of markets, that are not in this kind of a drawdown, that quite frankly have recently made new equity highs. Would I personally put my own money into those right now? Absolutely not. What I'm doing is I'm looking at the same things that Jack Schwager talked about and said, show me something that's worked over the long run and is currently in a drawdown. And the point he didn't touch on that we've just touched on is that Give me a way to measure how deep that drawdown may go. And when you put those pieces together, that tells me that your entry point here is ideal. And for those of you that want to trade aggressive, here's an idea to think about. I don't recommend this for everyone, but it's just an idea for more aggressive traders. If you go into this and you put your uncle point at 15.59, and we're currently at 9.5, so let's say you're willing to risk 6%. And that's going to be your uncle point. If it draws down 6% more, then it's beyond the 95% confidence range and something's off. What you can do is you can kind of back into an account size so that you choose a number that you'd be willing to lose in terms of cash dollars. Okay? Obviously, when you go into an investment, you have to be willing to risk some money, and you have to decide if this thing doesn't work out, despite our best intentions and research, what's the maximum cash amount I'd be willing to lose before, calling it quits and saying, okay, I'm done with that. Let's use an example here that number was $20,000. Okay. If there's 6%, if you're willing to risk 6% more, what you could ask yourself is $20,000 is 6% of what number? So if you say equals 20,000 divided by 6%, what that tells you is $20,000 is 6% of $333,000, $333,333. And this is a nominal amount that you could possibly fund your account at. Now, that doesn't mean that you would actually have to put that much in the account. With many CTAs, even if you tell them to invest your money as though you're a $300,000 account, you may only need to put up $100,000 in equity in order to do it. So I'm not saying you should do this. It's a more aggressive way to do it. But if you really wanted to maximize the potential for return and you were willing to be a little more aggressive and you wanted a logical way to determine what size account you should trade, that's one way that you could do it. Determine the cash amount you're willing to lose, figure out how much what number that would be 6 or 10% of, whatever you decide on the Monte Carlo sim, and that gives you the nominal account size that you could trade at. So anyways, that's it for this presentation. Please, by all means, if you have any questions, feel free to give me a call directly at 717-732-1319. And until my next presentation, I wish you all the best of success. Thank you very much.